Welcome back to the Daily Hunt, folks. It's Monday morning, and we're here to give you that crucial kickstart to your market analysis. Brooke, it feels like we've got a bit more to dig into today, doesn't it?
Absolutely, Ethan. After what seemed like a quieter Friday, the data bots were certainly busy overnight. We've got a good number of posts covering a decent spread of stocks this morning. And I'd say we've got a mix. Some really solid candidates that look promising based on our AI-generated insights, but also, some incredibly risky, shall we say, opportunities that are definitely more for the speculative crowd.
I love a good mix. It keeps things interesting. Let's not waste any time and dive right into the first one on our radar today. First up, we're talking about United Health Group, symbol UNH. Now, this one's showing quite a bit of activity, with 44 new posts just today. The overall sentiment, according to our analysis, is pretty bullish, mostly driven by what the community calls the inverse WSB mentality. People are seeing a very detailed bearish post and, well, they're betting the other way.
Yeah, and I get that, Ethan. It's a classic play sometimes. But let's look at the numbers behind the meme. The current price of $344.08 is significantly below its 52-week high of over $600. That's a huge gap. And while the PE ratio is a relatively attractive 14.90, which could suggest it's undervalued, we also saw news about UNH having a quarter from hell and dipping more than the broader market. That's a red flag for me. Is the market truly pricing in all those negatives, or are we just catching a falling knife?
To be fair, Brooke, the revenue growth is still robust at 12.9%. And let's not forget, the market commentary is often pointing to Warren Buffett's reported investment as a strong endorsement. Plus, our AI-generated insights noted comments about the bottom being in and ambitious price targets like $600 by February. I mean, if the fundamentals are still there and the market is overreacting to short-term headwinds, that PE and the discount from its highs could signal a fantastic entry point. It certainly shows strong potential.
I appreciate the optimism, but the inverse WSB strategy isn't exactly a KPI, is it? We need to remember that this stock has had some real operational issues. However, given the low PE, the substantial gap to its 52-week high, and that persistent revenue growth, I can see why it's considered a compelling long-term play if you're willing to stomach some volatility.
Agreed. Considering the low PE, the significant discount from its 52-week high, and ongoing revenue growth, our AI is flagging UNH as a buy. All right, next up, let's talk about Novo Nordisk, ticker NVO. This stock has generated quite a buzz, and our analysis shows a very bullish sentiment with a +8 score. There's a lot of excitement around future catalysts.
Absolutely, Ethan. The GLP-1 drug market is huge, and NVO seems to have a competitive edge with their new pill, which users are saying shows superior efficacy to competitors like Lilly. Plus, we're talking about a potential Q4 2025 FDA approval and even promising Alzheimer's drug trial results coming up. The current price of $55.61 is pretty close to its 52-week low of $45.05 after a sharp drop. Many see this as a rare buying opportunity, almost like getting Meta or Netflix at their 2022 lows.
I hear you on the exciting pipeline, Ethan, and that 35.6% net profit margin is absolutely stellar. It shows incredible efficiency. Plus, the 14.15 PE ratio for a pharmaceutical company with such growth potential is attractive. However, that sharp 10% drop we saw was reportedly due to news of potential tariffs from Trump. While some users dismiss this, saying NVO might be exempt, political risks are very real. And with Amgen and Pfizer stepping into the GLP-1 space, the competition is only going to intensify. How sustainable are those high margins long term?
Well, the community seems to believe those tariff concerns are overblown for NVO specifically. And a strong pipeline often allows companies to maintain a leading position even with competition. When a stock with NVO's fundamentals is trading so close to its 52-week low and still boasts such high profitability and growth, it's hard to ignore.
Fair enough. The current price being so close to its 52-week low, combined with that strong PE and exceptional net profit margin, NVO is a buy in our book. All right, let's shift gears to a tech giant, Alphabet, GOOG. Our AI-generated insights are pretty clear here, indicating a strongly bullish sentiment, driven by Google's recent advancements in AI and robotics, particularly with their Gemini Robotics 1.5 series. They're talking about robots that can truly think and learn.
That's certainly exciting tech, Ethan, and the numbers are impressive. A 13.8% revenue growth, a net profit margin of over 31%, and an astounding 34.8% return on equity. Google is clearly a powerhouse. However, the current price of $247.18 is very close to its 52-week high of $256.7. While the PE of 26.38 is reasonable for a tech leader, it's not exactly a bargain basement price. How much of this AI upside is already baked into the current valuation? And we're seeing general market commentary raising a bright red flag about Americans having more money in stocks than ever. That's a macro concern.
I appreciate the cautious perspective, Brooke, but this isn't just about general AI, it's about Google's leadership in robotics AI, which has the potential to transform industries. These breakthroughs don't just happen every day. The company's financial health with those incredible margins and ROE shows they can capitalize on these innovations. Even near its 52-week high, this is a company with strong, sustainable growth and pioneering technology that's just getting started. It's a market leader making significant strides.
All right, the fundamentals are incredibly strong, and that AI robotics potential is undeniable. Based on that robust net profit margin, healthy revenue growth, and impressive return on equity, Google is a buy.
All right. Finally, let's talk about Lithium Americas, LAC. This one has definitely captured the community's attention, with comments celebrating massive recent gains. The sentiment is cautiously bullish, which usually means people are excited, but also a bit nervous.
And for good reason, Brooke. The post explicitly mentions calls opening up 500 to 1,500%. That's explosive. The driver here is huge. News that the U.S. government is eyeing a 10% stake, pushing LAC to an all-time high. Plus, the company holds rights to the largest lithium deposit in the world. This isn't just a speculative play. It's a strategic asset for the future of EVs and U.S.-based mineral production. It shows incredible long-term growth, even if it's been volatile.
Oh, I agree it's a strategic asset, Ethan, but the KPIs here scream caution. We're talking about an earnings per share of negative 0.25, a net profit margin of 0, and literally 0 operating margin. This company is unprofitable, which means its current valuation is entirely built on future performance. And then there's the debt-to-equity ratio, nearly 20. That is an astronomically high level of financial risk for an unprofitable company. While the government interest is a huge catalyst, the stock has already surged from around $3 to over $7 very quickly. Even the original poster advised against chasing it now. This has all the hallmarks of a massive speculative rally prone to a significant correction.
Well, that surge does show just how much market enthusiasm there is for U.S.-based critical minerals. It's certainly a high-risk, high-reward situation.
High risk is the key phrase there. Given the unprofitability, the incredibly high debt, and the massive speculative rally that has already occurred, our AI-generated insights for LAC are to stay away for new investments at its current price. All right, based on our discussions today, here's a curated list for you to investigate further. Investigate as buy: United Health Group Incorporated Common Stock, UNH, Novo Nordisk AB, NVO, and Alphabet Inc., GOOG.
Now, for those of you who thrive on a bit more excitement, we've identified one stock from our stay away list where the community's optimism is still quite high, despite the risks. Remember, this is purely speculative and should be approached with extreme caution.
Investigate as speculative gamble: Lithium Americas Corp. Common Shares, LAC. And that brings us to the end of today's Daily Hunt, folks.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Exactly. Do your own due diligence, folks. Thanks for tuning in, and we'll catch you tomorrow morning on The Daily Hunt.